The day started out with the key inflation report, which came in slightly hotter than anticipated. We saw the year-over-year rate at 3.7%, which seems like miles away at what the Federal Reserve's target of 2% is. But yet our guest today actually says, look, things are actually looking up. We're going to be fairly optimistic for the fourth quarter, despite the higher inflation rate and the risk of what the Fed may bring next month. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
It's warm. It's warm. It's not hot, okay?
Sunny and warm. Sunny. It's hotter than probably New York, though. But we have a very special guest.
It's a dry heat. Thank you, Katie.
Kristina, we have a very special guest with us on Buy, Hold, Sell. Kristina Hooper. She is the Chief Global Market Strategist at Invesco, which currently manages well over $1.5 trillion for its clients. Kristina, welcome to the program.
Thanks so much for having me.
Absolutely. Well, we're going to start with you because we had that key inflation report that came out today, and really the anticipation was 0.3%, where we'd have a year-over-year increase of 3.6%, just a little bit hotter than normal, but still raised the alarm for Wall Street. Traders actually started selling off throughout the day. We saw the 10-year Treasury yield go up, actually hit 4.7% intraday trading. Where are you on this? Do you think that the Fed is going to tighten one more time? They're going to hike one more time in November? Or do you think this is just a pause for the time being?
I don't think the Fed is going to hike again, although it's not going to tell us that. It's probably going to continue to employ hawkish rhetoric. But what we've heard thus far is that the Fed is very much data dependent. And if it is data dependent, what we are seeing when we put together the mosaic of data is a very strong disinflationary narrative. Now, not every data point is going to be perfect. It is not going to sync 100% with our story. But what we saw today was fairly good. It was slightly off, but we're still part of very much a disinflationary period. And it should be because of the Fed. Now, I think the reason markets have reacted the way they have is because they've been walking on eggshells since the release of the most recent dot plot back in September. And there was one particular thing in that dot plot that concerned them, and it was the Fed's change for next year from what was implied to be 4 rate cuts to just 2 rate cuts between the June and the September dot plots. And that really set markets off and got them very, very concerned. But I will just remind that the Fed's dot plots aren't always incredibly accurate. In fact, if we were to go back to December of 21 and we look at their expectations for the Fed funds rate at the end of 22, it was a median Fed funds rate of 90 basis points. And of course, we know how that turned out.
Yeah. Hey, Kristina, I'm always want to find out from somebody like you who's has such stature out there. I don't get the fact that, you know, in like at Finance 101, there were leading indicators and there was trailing indicators. And why is it that the Fed completely disregards the actual leading indicators? Because if you took the leading indicators today, we would be at, 2.8% inflation rate based on leading, and throw out the real estate stuff. Because, if you look at some of the indexes that aren't from the Fed side, but Zillow index, I can tell you, I have a lot of friends who are big apartment owners, and their rents are going down in all the major cities. So leading or lagging, what do you follow?
Well, I try to follow all of them, but with a recognition of what is leading and what isn't. And I think the Fed tries its best. In fact, when Janet Yellen was chair of the Fed, she had created, for really her purposes, a 17-point labor market conditions index. The Fed is always trying to look at data, and it even looks at qualitative data, if I can call it that, in terms of the Federal Reserve Beige Book and the kind of anecdotal information that's provided in there. They really are trying to look at the big picture. Unfortunately, I think there is too much emphasis on that which is lagging, like employment. But even if we look at employment, that picture is looking good. It's not about non-farm payrolls and job creation. It's about average hourly earnings, and that is syncing very much with the disinflation narrative.
Yeah, you're so right in that, Todd. The other point I wanted to ask was, not only to the leading indicators, but I love you use the term narrative, because that's what I learned at Paine-Webber back in the day, which was that you could all you want to do it, but when a narrative takes hold, it's very hard to change it. And right now, I think I don't know, we have 50% of the people on the narrative of, oh yes, there's going to be a recession. Let me show you all these data points that say why the recession is a certain deal. And there's other people like me who says, well, I actually do math, and if you actually add up the math, for a variety of reasons, it's almost impossible. It's like we have this, gravitational pull that as soon as we get down to a certain point, the afterburners kick in because of the structure of the United States, and it drives me nuts that someone can just say, "Well, here's 50 data points and say recession." What's your case against a real recession?
Well, it's largely focused on how tight the labor market is and how solid the consumer is. And let me first point to the labor market. We have unemployment that's well below 4%. It is very, very hard to see a recession in a consumer-driven.
As in never, but
yes,
you're too nuts.
I never say never, but in a consumer-driven economy like the U.S., where the consumer is 2/3 of the economy, to see unemployment at 3.7%, it is very, very hard to envision a recession. Even if unemployment were to go up to 4.7%, I think it would be hard to see any kind of very significant broad-based recession. Number two is the health of households. Not only do some still have some level of excess savings, and there's a big debate on how we calculate excess savings, but some still have some. Their balance sheets are in order. And I think the key thing I would point to is the fact that, unlike the global financial crisis, when we look at homes with mortgages, what we see is that about 92% of them have long-term fixed rate mortgages, and the average mortgage rate is well below 4%. And that places the U.S. consumer in a very different position than consumers in other Western developed economies that do not have the privilege and luxury of having a 30-year fixed rate mortgage.
Yeah, I look at Canada, they've never had long-term mortgages. You go to Vancouver today, I was up in Quebec a little while ago. There's a world of hurt there. Americans don't understand that most countries, you have a variable interest rate and they reset every year, and they had just reset on October 1st in Quebec. And our hosts were paying 11.5% on a mortgage rate, which reminded me of going back to like the first house I bought during the great 16% inflation rates in '82, where I was paying 15%. When you tell somebody today that I was paying 15% mortgage, they will say, Toby, you're on some drug. But go to Quebec, go to Berlin, go to every part of the world except for the 30-year world that we live in. So you're dead on. Todd, let's have her on again, okay? She's up there right on.
That definitely. Well, Kristina, do you think the Fed reaches this 2% target for inflation?
I think it takes time to get there. But I think it does. There are going to be parts of the inflation picture that don't cooperate as much as other parts. There are going to be components that are a bit stickier, but I think the Fed does get to around 2%, maybe 2.3% within the next 18 months.
Okay. Well, here's the argument, Todd, quickly.
Go ahead.
The world is different. We're deglobalizing. All the disinflation that we had for 18, 20 years was basically offshoring, lower cost for all goods and then services, blah, blah, blah. Why shouldn't we, in a completely different world with the 115 economists they have down there at the Fed building, why wouldn't we expect a higher inflation rate given the deglobalization of the world economy?
Well, it's all about whether or not we have a countervailing force. So certainly we would have elevated inflation in a more deglobalized world. Although I would argue, I don't think it's going to be fully deglobalized. But what's really key to look at is that countervailing force, which in my opinion is technological innovation. Just think about artificial intelligence and what we've seen thus far in studies in terms of anticipating the level of efficiency that it can create for call centers. Imagine a world in which you're actually onshoring jobs and making productivity so much higher that you can live without the level of globalization you had in advance of 2019.
And clearly, the productivity rate was much lower in the same time we're talking about over the, in the last from 2005, let's say. So yeah, it is an excellent point. Countervailing is the word. I'll tell you, I wrote a research report today for a client of mine, and I was thinking about my old research assistant, who I would have said, "Hey, Sandy, get in here, and you got to do this, this, and this, and this, and get back to me in 2 weeks." And on Bing.com, and then on their other one, the other one they're doing, the Copilot, I finished it in 90 minutes, and it had every detail point, every link to the source. I'm with you. I'm with you. For at least for white collar jobs and for call center jobs and for routing. We have a client who has a software development that lowered logistic costs, labor costs, which is their primary cost, 30% by following your iPhone around and having it know where everything was. And CBS just put it into 55 different distribution centers because they can't afford to have a 30% higher labor costs than their competitors, right? So I'm with you.
Okay, and Kristina, before we go to the break, I want to go back to the Fed and the 2 to 2.3% target you had mentioned. If that is the case, then we should expect the Fed to continue to hike rates into 2024. Is that your belief?
It isn't, because the Fed does know and recognizes that there are lagged effects from monetary policy, both in terms of the impact on growth and the impact on inflation. So if it's moving in the right direction and they're comfortable with that, which I believe most are, and in fact, what we heard from Mary Daly last week is that, hey, the 10-year yield is doing a lot of the work for us. So in that environment, the Fed does not have to hike anymore. And I suspect it will start cutting sooner than we thought and sooner than they predicted in their most recent dot plot.
Yeah.
And let's not forget we have a presidential election cycle. And I lived in D.C. for 25 years. And rule number one around that little big building down there was you don't hike rates going into a presidential. Matter of fact, you cut them. Otherwise, there's some other Harvard or, Princeton place for you to go work, but you're not going to be working here.
Well, then with that logic, then, Kristina, then you're not anticipating cuts next year, though, are you?
To the Fed funds rate? Yes.
Oh, okay. Interesting. All right. Well, I like that.
Here first. How much? How much? Come on, don't hold out.
Well, it really will depend upon the data, but I suspect that, the Fed has implied 50 basis points in rate cuts next year. I suspect it will be more than that.
And we have a hell of a stock market next year, don't we?
We could very well.
I like that. I like that a lot. Well, that's a great way to close out this block. That's for sure. I love the optimistic tone. So with us today, we have Kristina Hooper. She is the Chief Global Market Strategist at Invesco. And when we come back after the break, we're going to ask Kristina about the upcoming earnings season, maybe some sectors to focus on, maybe some others to stay away. We also want to ask what she's telling Invesco clients. So keep it right here. We'll be right back after the break.
Buy, hold, sell, brought to you by CrossCheck Management.
Girl, it's been way too long. I got to get back in my zone. Hey. Hey. All right. Come on. 3, 2, 1. I'm feeling too good to be cooped up. Hey, ladies, don't we look good? We came to have a good time, baby. I'm feeling too good to be cooped up. Me and all of my girls, we gon' tear it up.
Ready for business
In brief.
Bloomberg Briefs puts the power of Bloomberg to work for you with over 15 industry-specific newsletters available only by subscription. Each offers proprietary data, researched and written by acknowledged experts. Top analysts, dedicated economists, senior business editors, all presented in a concise, uncluttered environment.
It gives me the edge I need.
Go to BloombergBriefs.com right now for your free 30-day trial.
I mean, yeah, let's talk about
Stop
today where I'm gonna go
Yo.
topics.
Roll it down. I am.
You don't need a car to listen to Sirius XM. You can listen anywhere. You know that, right?
What? Kevin Hart's Laugh Out Loud Radio.
Kevin, you could use your phone.
What? What?
Alexa, play Kevin Hart's Laugh Out Loud Radio on Sirius XM.
What?
This is how I know you're getting old. I guess that was it.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. We saw the stock market sell off today, right after we saw the inflation report, which actually gave us a year-over-year reading of 3.7%, just slightly higher than what Wall Street was anticipating, but probably nothing that's going to be earth-shattering, at least for the foreseeable future. But with us today, we have Kristina Hooper. She is the chief global market strategist for Invesco. And Kristina,
take a breath, Todd. Take a breath. Come on.
I know.
Okay.
We ad-libbed this whole thing. So, but Kristina, when we left it at the last break, we were talking about really the potential of whether we're going to see rate cuts, which I was surprised to hear your reaction to that. And you are fairly optimistic going forward. With the earnings season kicking off tomorrow morning, we have the three big financial companies coming out. And I know you're with Invesco. We've had a lot of strategists on Buy, Hold, Sell recently who are not very optimistic about the financials. But what's your take? Do you think it's going to be a great earnings season? Are you seeing this 10% earnings growth rate that some people are talking about? Or you think we might be a little bit too optimistic on that side?
Here you go, Todd.
Well, I'm a little cautious on earnings season, and I think that's a good way to be, right? I'd rather hope for the best and plan for the worst. What has been surprising is that earnings momentum has improved. The revisions have really been centered in a few sectors like energy, but also tech and communication services for different reasons. Energy, It's been all about the increase in crude oil prices, and for tech and communication services, it's been about the cuts that they've made that have improved profit margins, and other sectors not looking as good. So I think this is very much going to be a mixed bag this earnings season. I think we'll be pleasantly surprised with many of the companies in some sectors, but not all. And there will be some disappointment, marginally perhaps better than expected when we look at the big picture.
Well, I would, Todd, I'm now using just metaphors. I don't speak actually in sentences anymore. And big tech has been a life raft. It's been a life raft. And as an old money manager, the last thing you want to do is jump off your life raft. Excuse me, say it again. Life raft. There's one constant.
Yeah, tongue tied today.
Yeah, I got a tongue tied. I get excited when I think about the life raft. And so therefore, when we go into the end of October, where a lot of mutual funds, that's the year end, and you made profits and all this stuff, you're going to sell your crappy stuff. That's a technical term, Kristina. And then you're going to take a little bit of profits on your stuff that's won, so you even out your book, right? Now you get into November 1st, November 2nd, whatever the first Monday is, and you buy it the hell back because you don't get rid of your life raft, and there's very good reasons why Megatech, Magnificent 7, 8, 12, 15, whatever you want to talk about, is the life raft. So I don't see, you would be in a bite your nose to spite your face to take whatever year you've had and then throw it away because, it's overvalued. Really? You got 2 months. You want to make money or you want to lose your job?
Right.
That's what they used to tell me.
Right. Well, with that, Kristina, the first half of the year, we really saw a considerable amount of growth in the markets. I mean, and Toby's right. I mean, it was really the handful, the Magnificent 7 or whatever you want to call it on the tech side. But it was really just two letters, AI, that really was the octane for that bull market. But now, August and September seemed to really slow down. It really was helping the Fed with their argument because we're lowering the wealth effect. But going forward, is AI going to start coming back into this? Because everybody's looking at these tech earnings thinking that's going to save the day as it has all year. What's your feeling on tech? Do you think that's a sector that, are you telling your Invesco clients, yeah, okay, this should be the area that you should really be concentrating on?
Well, we really preach the portfolio of diversification, right? But to specifically answer your question on technology, there have been different headwinds and tailwinds this year. AI was very much a psychological phenomenon, an excitement about the possibilities, as opposed to anything that really showed up in earnings, right? But it was a powerful tailwind. And in fact, it helped overcome some of the headwinds created by rising yields. Now we're moving into what I think is more tangible, and that's actual improvement in earnings because there have been significant cuts made by technology companies and communication services companies, some of which used to be in the tech sector and just got relabeled, right? And to me, that's perhaps a more real driver, although the drivers do the same thing. They can drive up stock prices. And so I think that that's what we're likely to see as we head into the end of this year, is that earnings improvement drives excitement around technology and helps compensate for headwinds created by higher yields.
Yeah, and Todd, I would add that to support her point, because she's now my favorite guest ever, that if you take the average, what people in America do not understand is, in the greater Silicon Valley, whether that's Austin or Seattle or the Silicon Valley, those 385,000 jobs that they cut, the average salary, benefits all in, was $285,000 a year. Now, the average salary for any white collar work in the United States is significantly less than that, okay? So they have a 5 or 6 time multiplier effect on their earnings and on overall earnings, and yet they only cut 350,000 jobs. So that's the math that just is you can't refute. It's just that nobody really understands unless your kid works for Facebook and comes home and says, "Hey, listen, do you want to borrow some money? Because I just got another $300,000 raise, and I got a bonus, and I sold my Facebook shares, and I've got like $5.5 million in my account, and I'm 29 years old." Well, yes, and I can help you. So the dichotomy is not appreciated, in my opinion. And those jobs that we lost on a relative basis should have been lost. Kristina, when you hired 500,000 people at $250 grand a year, well, they could do it. But then one day, Zuckerberg woke up and said, I think we need the age of austerity this year, which was a nice way of saying, OMG, are we overstaffed? And they raised their profit margin 1,100 basis points.
Yeah. And let's be realistic. A lot of these companies were hoarding employees that really weren't providing any level of real productive functioning for the company. So the risk reward on this is pretty compelling.
Yeah, and I don't think the story's been told well enough, Todd. I really don't. And because it's just, when you look at the EPS, their revenue top line only went up 2.5%. Their bottom lines are going up 13%. That's called leverage, earnings leverage power, EPS power. And since they represent, what's the number now? 48% of the entire value of the S&P. They're going to have an outsized, value versus, the GLP-1 people who are getting crashed. I couldn't believe the hospitals got hit yesterday. The kidney frenzious guys got hit yesterday because they came out, report out that the GLP-1, weight loss drugs are helping kidneys. We have an index now of GLP-1 victims. It's now 125 stocks, Kristina, that are directly being affected by the new narrative, which is another money management thing I learned a long time ago. When that narrative starts that you're going to be hurt, whether it's right or not, I shoot first, we'll figure it out later.
Kristina, has Invesco, with their managed money accounts, have they changed their portfolio allocation at all this year? Maybe going more into heavy or overweight into bonds?
Well, we actually have very, very short-term tactical asset allocation portfolios. So you could see shifts on a monthly basis in portfolios like that. In general, though, a lot of it has to do with macro drivers. And so you could toggle back and forth between overweights and underweights. What I would say, though, is that in general, what we're seeing, and it's really it's a good thing to see for someone my age who has lived through years of many years of very scarce yields, is that we're seeing an abundance of yields in so many different sub-asset classes within the fixed income space. It's really exciting.
Do you ever remember utilities getting just bonkered as they are right now? I remember the widows and orphans back in the 80s. You know, we put them in waste management, and then we put them in the utility, Con Ed, and Florida Power, FPL, which is now Next Era Energy, down 64% in the last 9 months. I mean, are there sectors that you guys are, totally avoiding?
Well, no, we haven't talked about specifically totally avoiding anything. And again, what we believe in is diversification, and also for most portfolios having a long-term orientation. Certainly there can be components of a portfolio that are very tactically asset allocated if one does that professionally, right? But for most of the portfolio, it makes sense to have a long-term allocation and to be well diversified both across and within the three major asset classes, because it's not just about stocks and bonds, it's also about alternatives.
On the 10-year Treasury, what are you and your team seeing the yield topping off at?
So our expectation is that we think that it doesn't have much more room to run, and that we would anticipate that as soon as we see clarity on the end of the rate hike cycle, and that could take a little time because the Fed really is, I think, speaking out of both sides of its mouth and really trying to remain hawkish in a lot of its rhetoric. But once we have clarity that the rate hike cycle is over, I suspect that will be the end of, or that will be the peak of the 10-year yield. And that
how will we know we
have
clarity? How will we know we have clarity when they're one side's jawboning, the other one's, I've never seen the Fed more split between the.
When you see
Chairman
Powell walking into a room in a meeting with a briefcase, that's the signal. He's going to go back to the Greenspan days.
Well, thank you for that professional opinion, Todd. Let's actually get a professional opinion. Okay?
That's why our ratings are so high.
Exactly.
Well, as soon as we see, it could very well be something as simple as reading the FOMC minutes and seeing them talk about when they're going to start cutting rates. That's probably going to be a very clear sign that rate hikes are over.
Will you text me before you know that for a fact? Because when the market's up 1,000 points that day, I want to thank you, Kristina. I want to give you serious props.
Send her some flowers.
We'll see. I mean, it could be in his announcement, right? That we're looking ahead to rate cut. I mean, who knows how it's going to play out? I just think it's going to be pretty soon.
Okay. One final question for you. The war in Israel, clearly unrest. We have no idea where this is how it's going to end and when. Is Invesco just fielding calls nonstop from clients that are worried, wondering, what should I do? Should I just go completely into treasuries, or what are you advising everyone?
So, I hate to sound like a broken record, but it's all about maintaining that long-term perspective. We're going to have lots of different geopolitical risk events. Think about the Russia-Ukraine war, for example. And certainly investors even get jitters about elections. But the reality is that typically these kinds of geopolitical events don't have any kind of significant long-term impact on portfolios. In fact, I would argue that sometimes the biggest mistakes investors make is to get scared because of something. We saw many get scared, for example, during the GFC, with good reason, but getting out of the market and then missing out on a recovery and not knowing when to get back in. Sometimes that can be the biggest mistake that's made. And so again, it's trying to inform, looking at history and looking at what past geopolitical events have done in the grand scheme of things, and encouraging a long-term orientation.
I will tell you this, Todd. We picked up a bunch of 10-year bonds, sort of pretty doggone near 5%. And back in the old days, when I was selling bonds that were 16%, I told people that, do you understand that when they start cutting rates, your bonds are going to go up more than stocks? And they said, oh, that'll never happen. And sure as heck, those 10-year bonds, I remember selling a Louisiana pension plan. They generated a 30% IRR for 21 years holding those bonds. It beat their stock people, senseless. No one in the last 12 years has ever wanted to buy a bond because they were in a bull market for a long time, for 20 years, right? But there is an opportunity, Todd, to just lock in and sleep well at night with a 10-year bond, knowing that you're going to earn more than stocks probably in this new paradigm that we're in. But people never think of it. So I appreciate your point.
Absolutely. Toby, I think back to being in business school in the late 1990s and one of my professors bragging about all the bonds he picked up in the early 1980s when we were in middle school and couldn't pick up any bonds. And I think about him a lot.
For yourself, okay? I was flipping bonds at that
time. This isn't relatively speaking, this is a very attractive time for fixed income.
Okay. Just people, I don't know part of Todd mentions that people for the last 20 years have never thought about bonds ever. It was, because they kept going up in value. Pension people kept going up in value. I'm the smartest person in the world. Then they crashed, and the average pension plan, bond portfolio is down 48%. Which is worse than the stocks, by the way. Yeah. And so, history repeats itself. Maybe it rhymes, but right now it's going to repeat itself.
There you go. Well, I like it. I love that tone as well, Kristina. Just take the long view, and you'll be, looks like things will be okay. At least that's what history has told us before. So that's wonderful. Well, listen, we're going to leave it there. Kristina Hooper, thank you so much. She is the Chief Global Market Strategist at Invesco. And we can't thank you enough for joining us today. And we hope to have you back very soon.
God, she gets the BGE award. Best guest ever. I'm telling you right now.
Best guest ever.
Thank you. Tell me where to send the bribe check.
That's right. It's VIP. So
wait
listen.
a minute. I'm not a senator from New Jersey, okay? I can't be wrong.
All right. Well, thank you again. So on behalf of Kristina Hooper and Tobin Smith, I am Todd Schoenberger. Thank you once again to everyone for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
I want you to smash that like button.